The Fed President Jerome Powell didn't give a clear timeline for the first rate cut in the US in the first day of his semi-annual testimony yesterday, but he said something that everyone wanted to hear. He said that the only risk to the US economy is no longer inflation, but also the jobs market. So, bingo. Welcome, guys. This is Swissquote's Daily Market Talk. So Powell's testimony yesterday wasn't overly optimistic, but it revived the expectation that a rate cut in the US could be coming sooner rather than later, meaning sometime around fall this year. Because in the first day of his semi-annual testimony before the US senators, the Federal Reserve Chair Jerome Powell said for the very first time in 3 years that inflation is no longer the only threat to the US economy, but the cooling jobs market also is. Now, although the man didn't want to offer any clear timing or any clear timeline when asked, so when are you going to lower the interest rates? Well, he said that the latest jobs report sends a pretty clear signal of a cooler labor market. So the biggest takeaway here is that moving forward, there will be as much euphoria around the jobs data than, well, the inflation numbers. So yes, tomorrow's CPI update from the US will still matter very, very much, but investors will be more eager to put an accidental uptick, for example, or less than ideal numbers in perspective and somehow remain confident that things, in terms of interest rate cut expectations, are moving toward the right direction. As such, and with a strong sale of 3-year notes in the US, well, the US 2-year yield didn't take another dive yesterday, but consolidated its advance to the south following last Friday's soft jobs number from the US, remember, near the 4.60% level. And the US 10-year yield consolidated near the 4.30% mark. And Vanguard highlighted in its mid-year market outlook that bond yields are outpacing inflation for the first time in many years, which is obviously good news for long-term bond investors because the R star, so this neutral interest rate that the central banks are trying to find, but they have no idea where it is really, is still believed to be higher than before the pandemic times and before the inflation times due to a structurally higher inflation thanks to pandemic era heritage and the trade wars and the geopolitical tensions and demographic factors and also exploding government debt levels. So many investors out there also believe that we will likely see a bull steepening in the US yield curve, where the short end of the US yield curve will be easing more due to the upcoming Federal Reserve interest rate cut than the long end of the curve, which will likely remain under the pressure of political risk and also high and rising debt levels into the US elections, where both candidates, both Donald Trump and President Joe Biden, are nowhere near willing to control the government spending on the country. So that's it really. But anyway, overall, the US yields were lower at yesterday's trading session. They were under a decent downside pressure, but the US dollar didn't ease but gained instead. Why? Because I believe that a part of that demand for the US dollar was also triggered by a sell-off that we saw in the euro that hit after Moody's warned France that a sovereign rating is at risk if its finances get any worse from here, with a government divided into 3 big groups today, and two of these groups, the extreme right and extreme left, are willing to open their purse strings to stop Emmanuel Macron from easing spending to bring it to levels conform with the EU rules and also please the angry French voters. So the French 10-year yield actually jumped at yesterday's trading session, but the good news is that the spread with the German 10-year yield further eased as the German yields went up as well. The euro-dollar tested but found support near the 108 support, while the European equities didn't really have a good session yesterday. The French CAC 40 index dropped 1.56%. The German DAX index fell 1.28%, while the British FTSE 100 index, which has pretty much nothing to do with the political shenanigans on the continental Europe, and which is, on the contrary, promising a much warmer and a much pleasant political weather moving forward, fell 0.65% as BP shed 20 points to the index following a 4.30% fall after predicting a write-down on the value of a plant in Germany of 1 to 2 billion US dollars and warning of significantly lower refining margins in the second quarter. And the news comes just a day after Exxon also gave a lower guidance for the second quarter earnings, hurt by weaker gas prices and compressed refining margins. So Exxon is also under a rising pressure these days. The stock price lost more than 10% since its April peak. And diving into the energy prices here, while US crude recovered most of its losses post April but saw a solid resistance near the $85 per barrel level. The price of a barrel cleared a minor Fibonacci support at yesterday's trading session. The MACD turned negative for the very first time in more than a month, hinting that trend and momentum indicators are now in favor of a further downside correction in the short run. But oil is still in the medium-term positive trend that's building since the beginning of June this year, and support to this bullish trend sits near the $80 per barrel psychological level. And there is a good chance that we see dip buyers in oil return to the market at this level or close to this level, because keep in mind that the rising rate cut expectations are positive for reflation assets, and oil is one of them. Now, looking at gas, natural gas has been unable to stop the bleeding that started a month ago. Trend and momentum indicators here are, quite bearish right now. The only thing that could eventually slow the fall in prices, in nat gas prices, is maybe the fact that the market is now approaching the oversold market territory, which had, back in February this year, triggered a decent rebound in natural gas prices. Elsewhere, I will quickly come back to Jerome Powell, because the rising rate cut expectations after his semi-annual testimony yesterday sent the S&P 500 and Nasdaq to fresh record levels at yesterday's trading session. The S&P 500 renewed record for the 36th time since the year started, and bank and technology stocks were particularly cheery yesterday because bank stocks gained as Jerome Powell said that the regulators are close to changing their plan to force the big banks to hold significantly more capital, which means that they could continue just to lend this money instead of keeping it aside and make money out of it instead, while technology darlings like Nvidia and Tesla jumped at yesterday's trading session. On the flip side of the world, inflation in China came in below expectations yet again, while the Reserve Bank of New Zealand maintained its monetary policy rate unchanged at 5.5% level for the 8th straight meeting, and said that the policy will remain restrictive to make sure that inflation in New Zealand returns to their 1 to 3% target range. But the bank hinted that the degree of restraint will be gradually adjusted to the expected decline in inflationary pressures, which is expected to happen in the second half of this year. So the Kiwi dollar tested the 200-day moving average level to the downside, but could well find support near this level if tomorrow's US CPI update brings the Federal Reserve dose and the US dollar bears back in charge of the market. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.